to move on to Declan McEvoy, my own colleague, head of tax with Ifac, and Declan is going to deal with the topic of VAT. And Declan, if you're there, we know that customs declarations are very complex, but there are VAT implications which organisations need to be very conscious of. So will you talk to us about the VAT implications, if you don't mind? Firstly, maybe from a Northern Ireland perspective.
Yeah, we must remember now, with the UK leaving the EU, what's happening is we now have two distinct and separate VAT regimes within the UK. We've Northern Ireland and we have the UK mainland. Northern Ireland is still part of the EU for VAT on goods. So there is no change whatsoever with where we are with VAT in Northern Ireland. None. There is no change on the ground.
Just before you continue, you might stick on your camera there because...
I can't. I have no internet if I do.
Excellent. Then the UK, what's going to happen with the UK VAT regime?
The problem with the UK VAT regime is, and it's not a problem, it's the big change that's coming through. We're now moving to that the EU is regarded as, or the UK is regarded as a third country. So as a result of, as a third country, when we export from Ireland, it's no longer regarded as an intra-EU transaction, it's regarded as an export. So it's zero VAT when it's leaving Ireland. The VAT focus shifts to when it lands in the UK. So when it lands in the UK, it's where it sits within the UK VAT regime. So the UK purchaser or the UK buyer of the good will have to self-account for VAT at that stage on it. So
what does self-accounting mean, Declan?
Basically, they will have to pay VAT at that point if it's VATable in the UK. No different than an Irish purchaser buying something from the UK. They will have to account for VAT and pay it at that stage.
Okay, so let's just make this as practical as possible. So a business exporting yogurt to a multiple in the UK, how does the VAT changes impact on their on their pricing and on their ability, I suppose, to sell into the UK?
First of all, that each time they export to the UK, they'll have to use a customs export declaration, and it'll be submitted electronically using Revenue's automated system. So that's the first thing that will have to be done. So that is, they're going to have to get proof, number one, that it has left the country of Ireland and landed in the UK. So that's the first point. Secondly, then what will happen is the purchaser in the UK, depending on what VAT it falls into and what rate it will fall into, unless the UK purchaser has elected for a deferred accounting system or something in the UK, they will have to pay VAT at that time. You know, so what's happening is, up to now, because there were intra-EU transactions, there was no VAT payable. Now it's where it lands, the VAT is. So if there was a hybrid rate, say of 10% overall, it's adding 10% to the cost of that export.
So there's real commercial changes for the pricing of goods and for the deals that Irish companies can do with UK companies because of this VAT change.
Yeah, and the big thing that needs to be taken into account on that is look at the contracts that you have. Are the contracts VAT inclusive or EU VAT rules or wherever? You know, you need to go back to basics and actually look at the contract to make sure that the contract is VAT exclusive.
So that's the company, that's the Irish company that's selling into the UK. For the company that's importing a product from the UK, for example, a food raw material from the UK, they do further processing on that product in Ireland. Are there VAT implications for that business?
Yes, because depending on the VAT cost here in Ireland or the VAT charge on that, when that lands in Ireland, in order for it to get cleared from customs, the VAT must be paid. And it's back to the old regime, if anyone remembers it, VAT at the point of entry. So suddenly you pay VAT on it at the time coming in. Now, Revenue have a system in place of deferred accounting, deferred payment of VAT that has to be enacted by a ministerial order yet. But if that's done, what will happen is they will have the chance to defer, instead of at the point of entry, up to the 15th day of the following month. So if you bring in something in January, you'll have up to the 15th of February to actually pay the VAT and customs, which will be a cash flow benefit to you.
So we saw that Declan there with Lloyd, like where Lloyd is importing steel and will have to pay VAT at the point of entry. The deferred payment account, when that comes through, will be of benefit to the likes of Lloyd and other businesses.
Yeah, massive benefit. But the bar is fairly high with revenue in order to get it, because revenue can refuse it just on anyone. But if people are refused, there would have to be some good reason for revenue to refuse it. And if you think that revenue's refusal is too strict, you can go to the Court of Appeal, the Tax Court of Appeal on it. The one thing about the deferred accounting is at the moment it's been brought in for the UK goods only. It's about to be extended or will be extended when it comes in for imports from any third country. So there will be longer term benefits of it, so which will be a massive cash flow benefit to businesses.
Okay. The current scenario, Declan, would you do a comparison, like how a company is working now versus how they'll have to work from the 1st of January, particularly in related to VAT? I know it sort of summarizes some of what you've said already.
Yeah, at the moment, if they're exporting to the UK, it's not regarded as an export. It's regarded as what's known as an intra-EU acquisition or export. So that's number one. Number two, on a VAT return at the moment, when they're doing your 2 monthly VAT return and you're doing your VES, the VAT Information Exchange information system, when you're doing that, you just log, a quantity, and then on a separate form, you log who you're supplying it to, their number. This new system will be much more detailed and much more information and much more documentation to actually prove. The onus of proof is on the exporter to actually prove that it has left the island of Ireland. That's number one. So no difference to customs, a lot more paperwork involved, but relatively small in VAT compared to when we get to customs.
Yeah.
And the big change is for the importer. That's where the big change comes, because the importer is having to self-account for the VAT, pay for the VAT up front, or apply for the deferred payment system. And Revenue have stated that if anyone goes for the deferred payment system, they must submit their 2 monthly VAT returns on time, they must pay on time, they must have valid tax clearance cert, and so it's important that you don't fall behind, and also you log the import and export documentation correctly.
Like, this is an awful lot of extra bureaucracy for an SME. Forget about the big PLCs and the major food and agri businesses. It's a problem for them, but they have the resources to put a team of people at it. For a normal SME that has been exporting to GB, this is really a total change of pace in terms of bureaucracy, documentation, paperwork that needs to be dealt with.
Yeah, and it's going to, like any change, it's going to take a bit of time to get used to it. And software systems and accounting packages will have to adapt to try and make it easier for the SME to deal with it. And if we're here in 12 months' time, on the VAT end of it, everyone will probably turn around and they'll say, what is all the issue about? Because VAT is small relative to the customs and other items within it.
Okay. But it's not just VAT. There's excise duties, there's VRT. Maybe just mention a couple of lines about those.
Yeah, the VRT is the interesting one, because at the moment, what's happening is there's because when it's business to business, the VAT is deemed to be incurred in the UK. So now the Irish importer, as well as having to deal with VRT, he's also going to have to pay VAT on the car, no difference to where it is. And excise duty will form part of the declarations that's coming in as well. So, as you said, look, what's happening in this is just a layer of paperwork that's been introduced at a time when businesses are under pressure with COVID and everything, and this been thrown in on top of it. And note that there will be mistakes all over the place. And the one thing I would hope for is some type of a transition or leniency by Revenue, to allow people to get used to it.
Yeah, I think that's a very fair request. Declan, you mentioned last week to me just for companies that are in the UK and sending people over to the UK on for sales or technical, that they can maybe claim the VAT back when they're doing business in the UK?
Yeah, there is what one can do if one is over at trade shows in the UK and you have people staying, in accommodation, they're eating out or they're leasing a car, for their stay in the UK. What will have to happen there is that you will have to come along and you can make a claim to the HMRC to actually get back that VAT that is suffered and paid in sterling. The Irish won't refund it. It'll be up to you to do it. And again, it's a bit of paperwork, but it's something small. You might have only incurred 100 or 200 pounds sterling in VAT. There is a mechanism there through HMRC to actually be able to claim that VAT back on business expenses. It's on accommodation and meals, trade fare, travel costs, 50% of the VAT charge for hiring or leasing a car. But it can't be reclaimed on the cost of buying a car or goods for resale.
Okay.
So that because you're already entitled to the input credit for those on your VAT return.
Look, it's not going to move the dial particularly, but it is something that people should be conscious of.
Very
Declan,
much so. Yeah.
3 or 4 key points, couple of weeks to go, for those companies, and there are companies out there who haven't done much preparation as yet, right? In terms of dealing with the VAT side of it, what are your key points?
The first thing I'm going to say, and it's going to come as a surprise, is look at HMRC, VAT and Brexit. Really, really good portal, HMRC and the VAT. Loads of information about, exporting and importing into GB. So that's number one. Number two, if you have contracts with UK companies, go and visit those contracts. Make sure the contracts are robust and cover you from a VAT point of view. Because the worst thing that you can have is that the contract states it's VAT inclusive. And suddenly you're the person who gets hit for it. So come along in it. We're back then to a couple of the basic things outside that. And this is old stuff and people are sick hearing it. Make sure you're registered for Ross. Make sure you have an EORI number in place. And if you have those in place, at least you've done as much as you can here from an Irish point of view. And as a result of it, the last thing would be ensure your accounting VAT software is up to date to be able to handle these changes.
Okay, Declan, thanks very much. That's very good, and I appreciate that.